Hello again. This video is the last in the series for the second study unit on strategy as innovation. Now, you remember in the last two videos we've explored two theories as to why firms fail when faced with strategic innovation and change. Firstly, the idea that the cognitive limits of managers and organisations stops them recognising the nature of change that is occurring, in particular when that change is an architectural innovation. And then secondly, we explored Christensen's theory of disruptive innovation, where the firm makes rational and sensible choices to respond to an innovation and its markets being disruptive. Now in this video, I want to look at how we might use these theories to gain insight into a firm. Now, like with the theories of competitive advantage, when using theories, we need to stick with each theory in turn, gain the insight from it, and then look at what second or third theories will tell us. And then the insights are brought together to help us to understand in more depth what is happening and therefore make better, more robust decisions. So we need to first look at what has happened through the perspective of that cognitive limits theory, and then use Christensen's theory. Whatever you do, don't mix the two together. So using these theories, let's look at an insurance company called Guardian Royal Exchange. Now, this was a company with a long history. It was established in 1720, and that made it one of the oldest insurance companies in the world. And in the 1980s, it was either the third or fourth largest insurer in the UK. But the firm hit issues in the 1990s and was ultimately acquired by AXA, the French insurance company, in 1999. Now, arguably, a major cause of Guardian Royal Exchange's failure was the emergence of direct insurance in the UK from the late 1980s, championed by Direct Line. Now, Direct Line was established in 1984 and launched its operation in 1985, and by 1990 it was beginning its growth that would take it to the largest UK motor insurance company by the year 2000. So what do the theories of disruption tell us about how GRE might have been impacted by Direct Line's launch of direct insurance? Well, the first thing we can say was that direct was not a radical innovation. Many of the traditional insurance companies launched direct operations in the early 1990s. GRE launched Guardian Direct in 1994 and actually was one of the earlier traditional insurance companies to do this. Norwich Union, which is now Aviva, launched Norwich Union Direct in 1996. So GRE did have the competencies or was able to bring in expertise to allow it to adopt that new innovation. So it's clear the magnitude of the technology shift wasn't a problem for GRE. So let's step through the two theories we've explored, and we'll start with this theory of cognitive limits. So, was direct insurance as a type of innovation misread by the industry and GRE? Well, with the launch and early growth of Direct Line, you did see comments that approach will never work, or the technology is too unreliable to ever mean that customers will be served through the telephone. After a couple of years, those comments switched to questions about how Direct Line was underwriting its business. a belief that it wasn't properly understanding the risk of the customers that it was obtaining, so its claims would be much higher than expected, or its customers would just switch every year hunting for the lowest price possible. And underlying that was a belief that this was nothing new. They'd all seen examples of firms growing spectacularly through poor underwriting, only for them to fail a few years down the line. And therefore, the belief was that soon Direct Line would run into financial problems. So it does seem to be a belief that it wasn't changing the fundamentals of how you did motor insurance. If we look at those signals of what we'd see if a firm and an industry misreads an architectural innovation as component change, we see GRE ticking many of the boxes. Firstly, it did seem to misread the change as being a component shift rather than an architectural shift. Unlike Norwich Union, which came a couple of years later, that set up its direct operation as a separate business, GRE integrated its direct business into its existing broker business. In terms of how it's interpreting the signals it was seeing, while it was assessing the potential success of Direct Line based on the way that the insurance sector had traditionally priced risk, using largely demographic criteria to characterize the riskiness of customers. Direct Line actually was using a range of new data, for example credit scores, to come up with a different view of the risk of an individual customer. Also, in closely linking Guardian Direct with its existing broker business, there's a suggestion that it wasn't aware of the new architectural knowledge it would need to operate a successful direct operation. It's also clear that the priority of Guardian Royal Exchange, and to be fair, of other traditional insurance companies, continued to be on keeping its brokers happy. The belief inside these companies was that the broker channel would remain the dominant way in which customers bought motor insurance. As a result, insurance companies like GRE tended to starve the fledgling direct businesses of resource and funds. Indeed, the fear that brokers would take their business elsewhere if the direct arm started cannibalizing their customers led many insurers to restrict the customers their direct operations could market to. And lastly, almost certainly, the new direct businesses in traditional insurance companies were hindered by legacy, in particular the IT systems that had been set up to deal exclusively with the needs of the broker channel. So there seems to be a lot of evidence that GRE and many other traditional insurance companies were interpreting the move to direct as being a component innovation rather than having an impact on the industry's dominant design, the architecture of what is motor insurance. So potentially cognitive limits were playing a part in the industry's response to the emergence of Direct Line. What about the second theory, Clayton Christensen's view of disruptive innovation? Well, in terms of the value network in which Guardian Royal Exchange and other traditional insurers were operating, its main source of premiums was through the brokers. More than 80% of business came from brokers, and traditional insurance companies spent a lot of time and resources on ensuring the relationship with those brokers was as good as it possibly could be. So we're talking about long-standing, close personal relationships between brokers and the business development managers inside insurance companies. And linked to that, there would be professional support being provided to brokers and also various incentive deals for passing both volume and quality business to that insurance company. And of course, all that was supporting the broker's relationship with the end customer. So the ecosystem in which the insurers and the brokers were working was all linked together. Now the direct channel is a very different ecosystem, is a very different value network. Direct line was obviously linking directly to end customers and was perceived to be able to offer low price because it could cut out the middleman, and it emphasised that through its advertising. So we seem to have two very different ecosystems here, and Guardian Royal Exchange does seem to be highly embedded into their existing value network. So let's have a look at Clayton Christensen's framework. While like any other market, customers' expectations continue to increase. In motor insurance, while price is an important factor, you do see other factors in terms of the covers provided and the reputation of the insurance company. At the high end of the market, you get high net worth individuals in motor insurance with supercars, vintage cars or other specialist vehicles, whilst at the bottom of the market you'll find customers who are just interested in the bare minimum. And in terms of Guardian Royal Exchange, well, they operated in the mid-range of the market. And Guardian Royal Exchange did have good people working for it in underwriting and product development. And so over time, the performance of Guardian Royal Exchange's products was increasing. So in 1985, Direct launch. And to start with, it did appear to be a low-end innovation. It still had teething problems and its performance was below other insurance companies. And even by 1990, if you looked at the channel share of different routes to market, where you still saw that the traditional intermediary channels still had by far the lion's share. So direct or brand insurance was growing but very slowly. So for the traditional insurance companies, it was not a major worry. And indeed they had other new innovations that they had to think about. Tesco's and Sainsbury's were talking about whether to enter into selling insurance. Branded companies like Saga were also looking to expand sales of insurance to their members. In the US, you had the emergence of telematics and pay-as-you-drive technology beginning to be experimented with. And even in the broker channel, you saw new developments like expanded use of EDI to make the interfaces between the broker and insurance companies automatic. So Direct Line in those early days was just one of many innovations that insurance companies were aware of and thinking about. Now, of course, Direct Line improved its performance and was joined by other new insurance companies like Churchill. And in the early 1990s, you saw a rapid growth in sales of motor insurance through that new channel at the expense of the broker channel, to the extent that traditional insurance companies who were just focusing on those traditional channels were seeing a fall in market share. Now, Christensen's model predicts that at this point, incumbents choose to focus in on better customers rather than moving to respond to the new entrant. But this is not what happened. Guardian Royal Exchange launched Guardian Direct Insurance, so it made a response to Direct Line's growth. Now, Direct Line, of course, went on improving its performance, and Direct did seem to disrupt the motor insurance market. By the mid-2000s, the Direct channel had overtaken the broker channel in terms of its size. So whilst there is some evidence that disruptive innovation was part of the story of Guardian Royal Exchange, there are elements that don't fit Christensen's theory. And so in this case, it would appear that cognitive limits, that the fact that the change to direct was misinterpreted as being a component change rather than an architectural change, does fit better what we know about what happened to Guardian Rule Exchange. Hopefully you can see in that process of using both theories to see how they fit what happened in a case allows you to gain more insight. So now often when alerted to the issues of disruption, managers ask what they can do about it. And Christensen does talk about the innovator's solution, the need for organisations to protect themselves against that possibility of disruption. He talks about increasing the ability to anticipate and act, and this has strong linkages into blue ocean strategy that we talked about in the last study unit. He also talks about developing mindsets and values inside the organisation that are more open to change and willing to pursue possibilities, to experiment more. And in doing that, counsels organisations to be more comfortable with organisational slack, so having that freedom to experiment. And also, as we've seen elsewhere in the literature on strategy, Christensen points to a critical role both the leadership team and middle managers have in interacting with customers to understand what is happening and engaging in open innovation, co-innovation, so that customers are helping you to develop your thinking about what's going to be important in the future. Now, this all has important implications for strategy process, which we'll look at later in the module. But there is a question about whether or not firms should respond. In the case of cognitive limits, if the change is truly about the architecture, and so about a change in the dominant design for the industry, maybe incumbent firms would be better off managing the decline of the existing architecture and diverting funds back to investors so they can invest themselves into those new emerging areas. The same argument goes for Christensen's disruptive innovation. Managers are making the rational choices at each point, and so again, should managers divert valuable resources to make that last gasp effort to respond to the disruption? Or again, would they be better to pay those funds back to shareholders so they can invest into those new emerging businesses? Now, these issues link to the topic that we'll cover in the next study unit, where we start to look at the strategic responsibilities of the firm, starting with a look at corporate strategy. Thank you for listening.